Hi, Peter Boolkah here, and welcome to today's edition of The Transition Guy. Now, joining me today in the studio is Jonathan Fodera, who is the CEO of Integrated Business Financing. And you've been an entrepreneur for many a year, haven't you? And you've got
I
multiple
have,
businesses.
yes, 15 years now in small business lending, own multiple real estate companies, gyms, consulting companies, and three marketplaces.
How did you get started in sort of funding businesses?
Uh, Long time ago, I was working on Wall Street. I realized it was not for me. Got recruited to be an underwriter. I hated being an underwriter. Got moved into sales, realized there was a big problem with a lot of these fintech companies. And I said, you know what? I want to create something that's client facing that can serve the client with whatever they need, whether it's buying a piece of equipment, an SBA loan, short-term liquidity like lines of credit, or even startup loans and personal loans. So I basically found all the different programs out there that'll serve the client's needs. And I found the best relationships to source that. And I packaged it all together and I made a company that is client facing, which no bank is, no lender is, no fintech company is. And it's worked out very, very well for myself, my clients, my team. That's kind of how I built it.
And what's really interesting now, and the reason you're going to make a really great guest today, is you look at the world economic situation, it's far from ideal. And one of the things that keeps coming up is liquidity. And for many people, their inability to access good finance. Now, in the UK, we had COVID. We had an unprecedented period of total lockdown where we shut down. The governments were fantastic at supporting businesses through loan schemes, through deferment of tax payments, and all those wonderful things. And the assumption was that the economy was going to bounce right back, businesses were going to make enough money, and they'll be able to start paying all of those debts back, and life would be good. But the reality is the economy hasn't quite recovered. We've got inflation at levels that we haven't seen for sort of 40 odd years.
Yeah.
Some countries haven't seen it in their lifetime, in their sort of business lifetime. We've got global uncertainty in terms of geopolitical wars, supply chain issues, staff shortages. So businesses haven't recovered. They haven't been able to recapitalize their business. They've got all this money they owe, which means that actually their lendability has gone down. And they need to get through this period, get capital in their business and trade out of it, or both businesses and government are going to lose a lot of money.
Right. Yeah.
Is it possible, Jonathan, in this period to bulletproof your business financially?
Absolutely. Absolutely. But it's a lot of different steps. So let's take it back to what you started on. And you started on, we had a scamdemic, okay, all across multiple different countries, basically across the world. They've never shut business down like that. The big box stores stayed open. Everybody else had to shut, meaning small business. It was basically an attack on small business. Then we printed 40% of all the dollars that were in circulation, which caused the inflation, right? And then we had supply chain issues. And now we have labor shortages because when you incentivize people to stay home, it's hard to get good help to work for small businesses. Now, in the United States, most people are employed by small businesses, right? That's why that's part of my mission, support small business, because if we don't, our country looks nothing like it does today.
It's no different in the
So,
UK, to be fair. Same in the UK.
yeah. And so when this happened, now we have tensions with China and Russia. And now we have runaway and well, not runaway inflation. They're saying they're taming it, but the truth of the matter is when you go to fill up your gas, you go to buy groceries, you go to buy eggs. And by the way, eggplants and chicken farms are mysteriously going up in smoke. Okay. I think it's like 30 or 40 over the last 18 months. I don't think that's a coincidence, right? It's not like one piece of equipment, their equipment is malfunctioning and starting a fire. Very suspect. You have a pinch on small business like you've never seen. And with everything going on, for a business to survive through this, and I know we're saying this is really dark, but it can also be used as an opportunity, because the businesses that come out of this on the other side and be able to gain market share, they're going to be stronger, they're going to be healthier, right? There was so many businesses that closed, and that kind of wreaks havoc within the community, because the business owners are out, the employees are out, their families are out, and they're not supporting that community. Okay, it's very important to get back. It's very important to get more entrepreneurs into the ecosystem to build. And so I think if people understand how to bulletproof their business financially, that's going to be the key. And one of the things I will say is it's not just about getting the financing. Okay, you could get financing, but if you don't allocate those resources and deploy that capital in the way it's needed, the money really doesn't do any good.
Yeah,
Right.
and you know what? We've seen a lot of this where people have recapitalized their business and it's just to pay off the debts they already had. As soon as they've done that, the money's gone and they're no further forward than they have been.
Correct. So people need to get cash, right? So let's go into just basically what banks, what underwriters are looking at when they underwrite. And then from there, we can go through this strategy of bulletproofing their businesses financially. So first things first, they're going to look at credit. So they look at your personal credit, they look at your business credit. You should always be tracking and monitor both of those scores. Okay, the higher, the better. Next, they're going to look at time in business. Time in business, you can't really control, except you can hurt it. You can't help it. You can hurt it. You can hurt it by creating a new entity. You need to be able to prove that that business has been doing the same thing for so many years. And when you make that new entity, you have to keep that proof. And even then, it's an uphill battle, right? So I tell people, unless there's a real issue, don't change that entity, because it can come back and bite you when you need to get the right type of finance.
And how long would you say you need to keep the entity going for before it becomes viable and credible?
Great question. So typically anything under a year is a startup. 1 to 2 years, you don't have all the options available. After you've been in business 2 years, most, if not all, become available. And after you have 5 years in, you're considered much lower risk. So
because that was the challenge in 08, 09, is the number of businesses that crashed, phoenixed, but then couldn't necessarily get the credit lines or anything.
Yep. And if you remember back in 08, 09, they started cutting everybody's lines. Right.
Yes, they
so
did. That was the first
If you had a line of credit or credit cards, all of a sudden, if you had a $50,000 limit or a $100,000 limit, that was getting cut in half or almost turned off. Okay. Very, very scary thought, especially for an entrepreneur, because every single business needs a line of credit. You need it to take advantage of opportunities, for short-term uses, and for emergencies. Now, I don't have a crystal ball. However, I studied economics, and I've been doing this long enough where I see certain patterns. So the next big thing after time in business that they're going to be looking at is cash flow. They want to see how much is going into the bank, how many deposits. The more deposits, the better, because it shows a large number of clients. When you have a concentrated number of clients with only a few deposits, if you lose 1 or 2 or they go out of business, your business drops dramatically. They want to see consistency. They want to see how much you're keeping in the bank at all times. They don't want to see any cash flow issues. So they don't want to see any negative days. Super important, right? My rule of thumb is if you do, let's say, 200,000 a month, you need to be in that range of keeping 5 to 10%. So you need between $10,000 and $20,000 in the account at all times, right? That's just best cash flow practice. And then next, they want to see profitability. When I say profitability, it means, did the business make money? Did it lose money? How consistent does it do that? Rule of thumb, if you want an SBA loan, for every 45,000 in profit you claim, you can basically get 350,000 over 10 years. all right, at prime plus 275 or prime plus 3. Now, that's what they're looking at. Okay. Those are things that you have to monitor, that you have to try to improve at every step of the way, good times and in bad times, right? And a lot of business owners slip up on those. The next challenge that we have is you mentioned the geopolitical tensions. Well, we're kind of in a trade war. We're not in a fighting like physical war yet, but that could happen at any time. I hope it doesn't. And if I'm wrong, if we're wrong, the practices that I am preaching right now will help regardless. So these are just best practices. Now, the biggest thing going through this is you want to have excess cash. There's a quick SBA loan we've been helping a lot of clients with. As long as you have 700 credit, decent business credit, they don't even go off your profit margins. This is a beta program. They'll give you 30% off your top line revenue from the prior year, up to 150,000. So if you did 500,000, you can qualify for the 150, and that's over 10 years. If you did, let's say, 5 million, you can apply every 4 months for a maximum exposure of 450. That's a great way to get cash into the bank currently. And
Question for you on this,
you want to
because
use
obviously,
it.
quick question, because this is the US. I take it there's similar principles apply to banking across the world.
Yes, in terms of probably what they're looking at, absolutely. I don't know if the programs are similar, right? I have done very limited financing in Canada. I haven't done anything across the pond. Principles are the principles. I can't
That's the bit
imagine
I
them
want
being
to.
too much.
Good, and that's the bit I probably want to sort of stress. That is, we're talking about the principles. Although we're using examples from the States, the principles are what people should really be tuning into as well.
100%. So the first thing you need is to have the cash, right? So this is how the bulletproofing works. Have cash. The next thing is have access to more cash. I know that is incredibly redundant, and I'm going to explain what I mean. When you get a loan, you're paying on that loan the next month. When you get a line of credit, you can draw a little bit of it and have the rest sitting there, and you're not paying on it. So the next step would be to open a line of credit and to not utilize it. Okay. Just leave it there, let it sit there as a safety net, as something that can grab opportunities. All right. And then you have to focus on your business. And this sounds incredibly oversimplified, and it is, but I'll drill in and give you guys some real tactics, some real strategies that'll help you. So the idea is increase revenues, decrease costs across the board, everything you do. And over the years, I've seen certain patterns happen to business owners that they need to watch. So how do you increase revenues? Well, you get more clients, you make your clients more valuable, and you service them better, right? The idea is to create raving fans. The best marketing you could do is word of mouth marketing, referral marketing, right? In that same sentence, right, you should be looking for partnerships. You should be looking to develop relationships with suppliers and vendors. And I say this because 95% of my business right now, and it has been since inception, is always from partnerships and referrals. Okay. And why? Because I make sure that my clients have an extraordinary client experience. Okay. What I mean by that, someone applies, their credit isn't good, I get them financing, and I send them to a reputable credit repair company. We do a complete cash flow analysis, credit analysis, and we actually review it with the clients, and we let them know what could be and should be available. We also give them next steps on what they should be looking at, what they can do to improve and to hit their goals. All right. You walk into Chase, you walk into Bank of America, they're not doing that. So we go above and beyond. So think about how you as an entrepreneur can go above and beyond. Next, how can you create relationships with people that serve the same client base. And it's not just finding referral partners, it's finding referral partners that have the same core values as you, because the last thing you want is to bring on a partnership and they don't treat their clients well.
Right.
Okay, so you have to go through this. And the reason I say this is so important, because if you can establish these types of relationships, these types of partnerships, you create a win-win-win, a win for the client, a win for the partner, and a win for you. And in that nice little win-win-win, you're actually decreasing your cost of acquisition, which means that even in tougher times, you're getting more business done and it's costing you less. All right. And then if you could find a way that every client that you speak with, that you help, each client turns into 2 clients, and those 2 clients turn into 4 clients. Okay. Great example. If you know you're going to spend 20% of your revenue as a marketing budget, shave off 2, 3, 4% and put it to client experience. And how do you do that? Well, you send a gift, handwritten thank you. You send them a way that they can refer a business, right? I usually say, hey, don't keep us a secret. I give a complimentary strategy session where it's a QR code, it's a card that client can now send it or give that to any business he knows. And he knows he's going to look like a hero because they're going to go through the same process and their business is going to grow. Okay. Doing things to increase revenue like that, worth spending money on.
Yeah.
Okay. A lot of people don't. Next, when I talk about decreasing costs, there's so many times, and I've been very, very guilty of it, that you let certain costs run away. So if you're trying a new marketing campaign, and what I'm saying right now is not to cut marketing. That's never the goal. That's never the idea. It's be judicious with how it works. Figure out what is the highest returning marketing strategy or campaign you're using. Do more of that. And as you're testing new things, cut them really, really quick if they're not working. Okay, don't let them run. Also, audit your banks. What do I mean by that? Business owners don't keep good records. They don't keep good financials. They don't understand what's leaving the bank account. You need to go back, ideally 6 months, at a bare minimum 3 months, and see what you have in there. Put it into 3 buckets. I can get rid of it, I can shop it, or it has to stay. Because this will help you edit and lower your cost. Because I can tell you from someone that had some partnerships that did not work out. At one point, I had 3 offices that were being paid for, and only 1.5 half of them were being used. We had a boat club in there. We had other subscriptions for a different business. We were probably wasting about $10,000 or $20,000 a month. It adds up.
Why do you think people don't do that?
They get comfortable. They get lazy. They look at the bank account and they see, all right, I have $10,000 in there. I have $50,000 in there. And they don't panic until that number hits below 1,000 or 0. So these are just best practices that people need to implement, because I guarantee you can find that, right? You want to run wise, you want to run lean, but you want to be aggressive, right? Now, let's dig deeper into this. So you're working weekly, every day to establish these partnerships. You're going through your bank, you're editing the costs, you have cash, you have the line of credit. What next? Well, shop certain things that you may be able to save money on. One thing that we constantly see is payment processing. Save a lot of money there. The next one is certain types of insurance. I'm not telling you to do away with it. I'm telling you to, you should shop it on a yearly basis. Any service that you have, vendors, right? If you look at what happened when we had supply chain issues, how loyal were your vendors? How hard did they work to either extend you credit or to get you the inventory that you needed? Okay. Build great relationships with them and make sure that you're getting a fair price. If you beat your vendors up when stuff gets tight, when there's supply chain issues, guess what? They're not going to go to the guy that just beat them up for every last penny.
Well, that's happening now as we speak. where people have done that coming out of COVID, absolutely battered people, then you're right, they're not being supported.
Correct. So relationships in great times are very, very valuable. In bad times, they are essential. And a lot of business owners, when it gets tight, they don't value their relationships. And that is a huge mistake. Okay, I know we're talking about financing here, but I'm also talking to you about best business practices that are going to help you. Because I could get you all the money in the world, and if you don't allocate it properly and you don't put these things in place, it's not going to matter. Okay. So that's kind of the idea, is review everything that you have going on, get the cash that you need, have access to more cash, and then look for opportunities, because there's going to be things that are going to pop up that you might be able to take advantage of. We all know rates are rising. So, example, less than a year ago, we had SBA loans that were going out at sub 7%. We had equipment financing we were doing at 6, 7, 8%. Now SBA loans are going out at about 10%. Okay, 10 to 11. And on top of that, equipment financing is really 8, 9, 10, 11, 12% over 5 years. Okay, the term loans we were doing, we had, bottom was like 6%, 7% simple interest. Now we're seeing the bottom at 12 to 15% simple interest. So rates are rising. I don't see that pulling back anytime soon. And what that means is when you take out financing, you have to think, one, how much am I going to make by implementing and deploying this capital? Okay. Does the increase in cash flow cover and far exceed the payment? The next thing you have to analyze is, if I'm paying, let's say 11, 12, 13%, am I at least making that on the money?
Right.
Okay. The idea of financing is you should be using it for growth. And when you deploy it for growth, it needs to pay for itself, both from a cash flow perspective and a cost perspective. And most times it does. Okay. And then it's just a matter of, is this the right program? Is it the right fit? And am I getting a good deal or a fair deal? And if all those things align, you should be moving forward with it. Right. Now, the next thing is using the right program. Okay.
Right.
I've seen a lot of entrepreneurs use the wrong program and they get burnt. And it creates either massive cash flow challenges, credit challenges, or it puts them out of business, right? So for an SBA loan that's going out over 10 years, and here's a good rule of thumb. The term that you have with the financing should basically be over how long you utilize it. So here's what I mean by that. An SBA loan is great to consolidate debt. It's great to buy a business. It's great to buy a building. It's great to have to put in the bank. Why? It's a very, very long-term line, and you're going to be doing that over the life of it. Like when you buy a building, that's why you pay a mortgage over 30 years. Well, same goes in reverse for short-term stuff. Like when you buy equipment, you're going to use that equipment for 3 to 6 years. Well, you should be paying for it over 3 to 6 years.
Agreed.
When you have a line of credit, or let's say invoice factoring or a working capital line, those are things that are really for short-term needs. Why? Because a line of credit, you're going to draw from and pay it back. You're not going to keep it loaded with a balance. So that's for marketing, supplies, inventory, adding to your staff, and emergencies. That's, if you're using the right program for the right fund, for the right purpose, you won't get in trouble and your business will be well capitalized. When people mismatch the program, you're going to be in trouble.
It probably gets even worse than that, is when people think it's a good idea to use cash flow to buy capital equipment.
Oh, that's a huge mistake I see all the time. Okay, because then they're cash short, equipment rich, and if you have to utilize that equipment to actually then go get cash flow, it's much more expensive and it's shorter term. Whereas if you paid for it for equipment financing, with equipment financing, there's a couple of things. spreads it out, it increases your cash flow. And two, it builds something called comparable debt. When you're building comparable debt, after you make 12 payments on any type of equipment for the business, it counts towards your comparable debt. And the rule of thumb is, if I have $100,000 of comparable debt, I should at least be able to finance a $200,000 piece of equipment on the next go round. So what you're doing is not only are you getting the equipment you need today, but you're setting up for the equipment you could use and need tomorrow. Versus somebody that, just like you said, pays cash.
Yeah, and it's interesting because a lot of people say, well, if I've got the cash, I might as well use it. But unfortunately, when you want to scale a business, scaling a business consumes cash faster than you would ever care to admit to or realize. That's why you've got to conserve the cash.
Yep. Conserve the cash, find other avenues to deploy the cash, or, invest, right? People think that running a business is a zero-sum game. It's not a zero-sum game, right? You should have a checking, you should have a savings. And if there are things that you can do to invest in the business to safeguard some of that cash while earning a return on it, you absolutely should.
So here's a quick question for you on that. Because I have people saying to me, well, I've got cash in the bank and the cost of finance has gone up. Why would I want to be paying the extra finance when I've got the cash in the bank? What would you say to them?
Well, that's a great question. And here's what I would say. The rates have risen, but if you look back over the last, let's say, 70 years, 100 years, we're right in line where it's always been, right? This is about the average, right? We had a period of, let's say, 5 years, 4 years, 5 years, that it was historically low. Okay, we were basically giving away money for free, both governments. So you can't compare stuff, or you can't compare those rates to normal lending rates, number one. Number two, you get a write-off. So all the interest can be written off, and that can help your tax liability at the end of the year. And then three, I'd rather have the cash to deploy or have for emergencies or opportunities, and continuously build my business credit and my personal credit by borrowing responsibly. Notice how I said responsibly. Then utilize my cash in the bank. Here's another great hint for you. And this is why I love doing this. And this is why everyone needs to enact and implement these steps. The best time to apply for financing is when you don't need it.
Yeah.
All right. And I'll say that again. The best time to apply for financing is when you don't need it. Your credit's strongest, your cash flow is strongest, your application and your whole financial package is going to be way stronger. So you get approved for more, you get approved for longer terms, you get approved for better rates. If you wait, the biggest mistake I see entrepreneurs make is they wait until they have all these challenges, either with credit, cash flow, or all of them. And now they're in a situation where they don't have the leverage, right? Where they don't have options. So they'll get, if they do get approved at all, they will get more expensive, shorter term options that may or may not help the business versus waiting, and doing it when you don't need it. Because again, you want to plan ahead.
That's the point about building your business profile, though, is have that as a strategy and make sure that you build up your credit score so that when you do need the finance, or you do go for finance, you get it at the prime rates, not subprime.
Exactly. I think people don't plan enough with their business, right? There's so many entrepreneurs that just look in the account. They may or may not look at their accounts receivable, and they just think, hey, I'm good. I'm good for this month. I'm good for next month. Well, the challenge is, if you really want to grow, you really want to scale, it is also a strategy. It is also a thinking. It is also planning ahead, right? And it's somewhat forecasting what's going on and matching what's going on the outside, and then also what's going on in your industry, and then what's going on with your clients, and making it all make sense together. Okay, right. So my assumption is that we are going to have less and less discretionary income over the next 6 to 24 months. That means that people will probably be very judicious with how they spend their money. And that is why I stress create raving fans, create an amazing client experience, and have the money, have excess money, and have access to extra money. Okay. And then have that financial flexibility to do what you need to do to continuously grow the business wisely so you can come out of everything that we're going to go through way stronger, way better, and bigger than ever before.
And the reality is you don't need to spend the money. You've got access to money. Doesn't mean you have to spend it.
Correct. Correct. If it is not going to produce a really significant return, I'm probably keeping it in my bank, and I'm keeping the lines open. Now, one question I get is, hey, well, what if I have a lot of debt that is not good, right? High interest rates, credit cards, things that could potentially hamper. Well, if you get the SBA loan or any type of longer term loan and consolidate it and keep the extra, whatever wasn't used, in the bank, and then get access to a line of credit, that is a good decision because that's going to keep your cash flow strong. You're not going to have all those different payments from credit cards, other financial lines. And so you can work from that approach too. It doesn't have to be a perfect slate, but you have to make it perfect over time.
Now, just another question, because there's been a lot of talk out there. Because, I mean, I'm a firm believer in access to cash and having access to facilities. But a lot of people are saying, well, right now is the worst time to keep cash in a business because of inflation. And inflation's eroding away the value of the cash, especially when you're looking at 10% inflation. What's your thoughts on that?
That's a great question. You can't control, right? So what I would tell you is utilize or try to find a return for that cash. Okay. So don't have it sit there. If you can find short-term things, always going to be meaningful. But by the way, as that inflation goes up, if you have a fixed rate, your rate actually, that also eats into your repayment in a positive way.
Right.
Now, if it's a variable rate, it's obviously going to match inflation. But there are things that you can invest in. If you have a high margin product that sells, well, buy more of it and build a campaign around it. So there's definitely ways to utilize that cash that can help you in the short term and in the long term protect from inflation. I don't want to go over high risk strategies here. I'm quite comfortable with them, but hard assets are always solid in inflation or inflationary times.
Okay, that's a good explanation.
And if you look back in Germany, the Weimar Republic, you know what they were doing? They were buying equipment. They could not buy equipment. They could not buy equipment fast enough because it was a hard asset. It would also protect and allow them to produce more. And they had some of the highest inflation ever recorded. And I pray that doesn't happen. I'm not saying it's going to happen. I just don't know how people would go through that. But they also had that problem because a lot of their debt was, held on foreign balance sheets and not denominated in their currency at the time.
And that's a good example. Actually, that's a great example. So what else do businesses need to be focused on in order to bulletproof themselves?
I can't stress enough their clients, right? So other ways to make clients more valuable would be figure out what they need and provide it. Right? Everyone needed to raise prices about 12 to 18 months ago. Some businesses still haven't.
Agreed.
I understand that it is tough to raise prices on clients. However, if you create more value and you go above and beyond, and find other ways to serve them, that will help, right? So if you're a gym offering a nutrition plan, and you can charge more, then you can charge a premium. What we do is we try to find other services. I'll use my firm as an example. We find other services that businesses need that don't cost anything but mean a lot to our clients.
Right.
So we come in and we do a review and we do the strategy session. One, that differentiates us. Two, we're also looking for ways to improve. So if they don't have a line of credit, we'll see what they qualify for and we'll add that to whatever we're doing. Three, we'll take a look and we'll analyze how they're accepting credit cards and how much money they could save them if they switched platforms and their setup. And so we look for these little inefficiencies that, hey, we might get them a line of credit, and then we might be able to save them $1,000, $2,000, $5,000 a month, switching over their payments. And now, instead of just coming to us for an SBA loan, they're bulletproof. We bulletproof their business. They don't even know it, right? So we got them the SBA, we got them a line of credit. They don't have to use the line of credit, and we're saving them monthly on a service that they were already using that they needed. Okay, so we increase their cash flow and we decrease their cost. Where do you think that client is ever going to go anywhere else? No. Think about how you can do that in your business. What other products, goods, or services do they need? What's going to help them the most? What are their biggest pain points? And bring those on. Where people mess this up, okay, and I have made this mistake several times, they go off board. And what I mean by going off board is that if it doesn't fit your ideal client and it doesn't serve your client base, bringing on a different product or service is not going to help. It's going to confuse your team, it's going to confuse your client. And now instead of marketing for this avatar, you're marketing for two avatars. So you're doubling your cost as opposed to just increasing your revenue by figuring out exactly how best you can help your client with other things.
No, and okay, so I'd love to hear your take on it, because some people do struggle to get finance from a bank. That's going to be a fact. And very often I hear people turn into friends and family to recapitalize the business in times of hardship. And they often do it to start up their business. What's your take on friends and family when it comes to finance in a business?
I try to stay away, and here's why. If things go south, it creates tension. I have personally done this. Okay? When things don't get paid back on time, or if there's a misunderstanding, now Thanksgiving, Christmas, whatever holiday you want to choose is now awkward. Okay. And it's not a good, as an entrepreneur, it can be stressful enough. You don't need to add more stress by going with the friends and family. You also can't write off friends and family. Okay.
Right.
Now, things go well, you pay them back, and you get out of what's going to happen over the next 6 to 24 months. Well, they may just think that they have a piece of the business or they have a say in the business. And that creates tension the other way. So I would avoid friends and family at all costs unless it's the only thing that can save you from keeping your doors open. And you should never take money. If there's a challenge, if the business isn't doing what it needs to do, I don't care who is providing the capital or the liquidity. You should not take a dime of it unless you already have a plan on how to turn it around. I see so many people just take money to take money, and they don't have a plan. They don't know why they're struggling, why they're failing, why the business isn't doing what it's doing. Right. So the reason we talked about financially bulletproofing your business, we gave tactics and strategies and things that you can work on. If the business isn't operating smooth now is the time to take apart the race car, figure out what isn't firing, and put it back together. Right? The time is not borrow the money and then do that, because now you have a payment on top of that.
Yeah, and sometimes, like you talk about taking the business apart and everything, sometimes the business can't be put back together again. And instead of going out there and taking on more capital, more debt, and more exposure, sometimes you've got to know when to call it a day, right?
Yes. It might just be the dynamics of the industry changed, of the client changed. You know, we talk about what's going on right now with Chat GPT and being on the forefront of all this AI. That's going to replace a lot of jobs. There's also massive opportunities, right? So
Absolutely.
it's it's a crazy time, you know, and you have to stay ahead in your industry, in technology in general. I think there's going to be massive gaps and leaps made over the next 24 months, which is a massive opportunity. But you have to be all in all the time.
And that's what people need to realize. Money's shifting now. Money is shifting. It's not moving in the same direction that it has moved in the past. And we've got to be agile enough to move with it.
Correct. Correct.
Are there any other bits you would add to what you've already sort of spoken about?
I think we went pretty deep on concepts and tactics. I think that if anybody has questions, they can reach out. If there's anything you feel I should cover or go deeper in, I tried to make this as quick but as impactful as possible.
Which I think you've done an absolutely stellar job. But if they wanted to reach out to you, how do they go about and do that?
Well, on Facebook and Instagram, it's Jonathan Fodera. And on YouTube, and I have a whole lot of videos there that explain every little facet. It's integrated business financing. And then the website is integrated business financing. You can definitely find me on any of those platforms. And I am happy to help everybody because, like I said, I support small business because I know the impact it makes in families and communities. And that's what this is about. When times get tough, it's about your relationships. It's about the impact you can provide to others.
Brilliant. No, thank you very much for that. And if you
Thanks
enjoyed
for having me.
today's episode, please make sure that you like it, subscribe so you don't miss future episodes, and please share it with others so they can also benefit from Jonathan's wisdom. And if you have any questions and you want to delve a bit deeper, you can always head over to Boolkah.com and get in touch. Thank you for being such an awesome guest, Jonathan.
Thank you for having me. Happy to come on anytime. This was a blast.
It's been an absolute blast. And remember, failing to learn is learning to fail. Take care.